If you answer any of these questions with a no, then this video is for you. You have to watch till the end to become a profitable trader. The first question is, do you have a solid trading strategy with all the rules? If your answer is no, you have to watch this video. Do you know where to enter the market? Do you know where to put your stop loss? And lastly, do you know how to make your take profit levels? If all of your answers is still no, then you have to watch till the end, because this video is packed with some valuable information to help you to become a profitable trader. And before we begin, all the timestamps will be in the description below. Also, please join our Discord server to get this kind of signals for free. So let's begin with the first topic of this video, which is the structure that you need to trade to understand how the market moves. So let's begin with this structure. This trading strategy is based on the ranges of the market. You have to understand that clearly. So the first thing that you need to understand is the structure. This is the only structure. You can pause the video and draw everything down. I will also put this image in the Discord server. You can come and download it and print it out. Without wasting any of your precious time, let's begin with this video. The first thing that you need to understand is the ranges in the market, how the market moves. This will also benefit you to become a profitable trader even using other strategies. So the market moves in impulses and corrections. Impulses move aggressively. Corrections take time before we can see another trend to continue in the direction of the previous impulse. So in the impulse phases, we can see that we have this box here. We have the main box, which is red. We have another box, which is yellow. And lastly, we have another box, which is green. You might ask yourself a question, why do we have impulses inside the impulse? It's because in a correction, we will also see impulses. Even in impulses, we will see a correction. So let me explain this pattern, because this will help you to structure this trade setup efficiently. We see that we have an impulse like this. This is the day one. We have impulse like this. This is still the day one. But inside this impulse here, we can see that we have a correction. We have another correction right here. This is the starting point of the impulse. This is the ending point of the impulse. This move here, maybe let's say we are in the 4 hours time frame. For example, like here, this move can take even a day to complete. And then in the next coming days, we can see a correction, a slow market for the next coming 5 days. But this day 1 and 5 days, this is just an example. It can be even higher. Sometimes it can take 2 days. Here it can take up to 20 days. It all depends. But when we move forward, I'll show you some examples and the structure that you need to trade. And before the market can move, we also have to see a demand zone. Here we have to see a demand zone right here, and then we still have to find a fair value gap around this area. So that means we are done on the day one. The most complicated part is on the correction phase. On the correction phase, the market will move opposite direction of the impulse. We can see that the impulse is bullish, so that means the correction should be bearish. As we can see, this is just a bearish trend, and we can see that the market is just trading lower and lower. So after this impulse has completed, we will see a correction phase like this. This day 5 here is this one here. Can see some impulses here. At the end of the impulse move, you will see that the market will shoot lower aggressively. This move here is the same as this one, but this time is just bearish, but in the lower degree. And then we will have a correction. This correction can be the same as this one, this bigger one here, but in the lower time frame. And then inside this whole impulse here, we can see that we have another impulse, which is green, this one here. We can also see that we have some impulses. Even on this area, impulse, and some few corrections in between. Okay, so to understand the structure, you just have to know this main impulse, and then the rest is history. You have to wait for this aggressive move in the market, and then wait for the market to create a huge correction before we can see another move to the upside. And remember guys, this trading strategy is so powerful, very, very powerful. I've been using this for so many years. When I see those kind of structures, I make sure that I never miss them. So that's why I am making this video, so that it can also benefit you for free. The only thing that you can do right now is to like the video and also subscribe to the channel for more future content like this one. So let's move on, because right now you understand the structure here. Right now, where should we enter the market? This is the next chapter of this video. Let me show you how to enter the market. This is the second chapter of this video. This is how you enter the market. It's pretty much simple to understand. The first thing that you need to do on this area, on this impulsive wave right here, the market will be shooting higher, making some silly moves because this is a correction. So after the market has finished making some silly moves right here, you will wait for the market to come down, touch this demand zone here with this wick right here, to touch here, and then close with this bullish candlestick. Close, remember this, guys. The market should also close with this bullish candlestick right here. You don't use a buy limit order or anything, because the market can still shoot lower like this. So we have to wait for the market to come here and close with a bullish candlestick before we can decide to trade higher. So this is how you enter the market. So you might be asking yourself a question: what if the market come to this area and then do something like this and trade below our demand zone? This is when you should avoid taking this trade, because in this video we have to follow the rules. So from here, guys, if the market do something like this, you just have to avoid it at all costs. So we have to see something like this. You will see when we move on to examples that this trading strategy is more powerful and it can boost your trading account with some huge profit gains. So let's move on. You will see. Right now, I have to show you how to place your stop loss. It's pretty much simple. Your stop loss will be below the zone. And also don't forget to add your spread size. Your stop loss will be something like this. You will enter around here and then move higher like this. Don't worry, this another way that you can make some sniper entries around this area using these previous candles. The video will be here around this area here, and I'll also put it in the description below so that you can also check it out. That will also make you a sniper entry in this kind of trading pattern. So from here, where should we put our take profit levels? Is pretty much simple. You can use a Fibonacci extension or a Fibonacci retracement, it doesn't matter. But if you don't have those kind of tools inside your trading platform, you can just use this line tool here. You start from the starting point to the high, to this high, and then put it above here. So your take profit level will be around this area, but the first take profit will be at the previous high, which is this one here. So this trading strategy can help you to get those 1:20 trade setups. That's how you make your take profit levels. So let's move on to a real chart so that I can show you an easy example. You don't need any time frames or anything to analyze in the higher time frame. It doesn't even matter with this strategy, because you can still spot them directly from the market. But sometimes it's very important to do your top-down analysis. This is the first example on the CAD CHF on the 30 minutes. Remember, 30 minutes time frame. You can see I'll do some multiple examples in other time frames too. The first candlestick here, this move right here, guys, it should be very strong like this one. As you can see, this move is very aggressive. And let's measure this range here. We can see that this move took only 4 hours to complete, but moving forward to this one here, this is the ending point of the impulse. It's like 7 days, but in the 30 minutes time frame. So every time when you see this kind of setup, just remember that I told you to enter it without hesitation. But I'm not a financial advisor. Don't even trade it. This is just a video for fun. So from here, you have to mark up your demand zone like this. We have a demand zone like this one, and then let's mark our high like this. You can see that we have this thing here for take profit levels. This is your take profit here, but our first take profit will be at this previous high here. So from here, and then we will put our stop loss below the zone like this, because we have to also add our spread size, because we all know we have different brokers. I personally use IC market. So from here, we need to wait for the market to come to this zone, touch the zone, and close with a bullish candlestick. Let's move forward and see. We are waiting for the market to come to the zone. The market is coming to the zone. Okay, the market touched the zone. Right now, the only thing that we need to wait for is for the market to close with a bullish candlestick. Let's wait and see. Okay, the market closed with a bullish candlestick. Let's remove this one here. This is a close. That means the market is confirming that we might potentially move higher. So we will enter the market right here, put our stop loss here, and then this is a 1:10. We will copy this one and put it right here. This is an easy 1:21. So let's wait and see how the market played out. Okay, almost stop loss hit right here. Almost, because right now we have added our spread size. The market didn't stop us out, but this move is very minor. So let's play and see how the market unfolded from here. We can see that the market is still pushing higher, waiting for the first take profit to be hit. Let's wait and see. The market is playing around. What is going on? You have to be patient because you started to trade this patient. The market hit our first take profit level around here, so that means this trade is out, and then this one we can put it to break even. Right now the market was pushing higher and high. So when the market breaks this high here, when it breaks this high like this one here on our first take profit level, you have to move your stop loss to the low. Eventually when the market breaks to the new high, when the market breaks this high here, you place your stop loss here. It breaks another high, put your stop loss here. It breaks this high here, you move a stop loss here. But eventually you can still use this highs here in this lower degree to avoid this move here. You can see breaks new high, put your stop loss here, breaks another high, and then when this move happens, you are out of the trade. So let's move on to another example. We have another example on gold. We can see that we have a low here. This is the 5-minute time frame. We can see that we have a correction here, and then we have a demand zone around this area. Also, we can see that we have some fair value gaps here, but in this area the fair value gap has already been completed. So from here we can see that this move is very aggressive, but on this side is very slow until we see another move touching this zone here before we can shoot higher. So your entry will be here when the market touches the zone and close with a bullish candlestick. Put your stop loss below, hold the trade to this previous high, and then take your profits and move on. But this trade is just a 2:1. I don't like it at all. I'll never trade anything this big, and some of them can be as complicated as this one here. We can see that we have an aggressive move to the downside, and also we have another aggressive move to the upside, but this whole area here is very corrective. We can see that if you compare this and this move, the move is very aggressive to the upside and started to be slow, and then the market came down to this demand zone, close with a bullish candlestick, and then shoot higher. Can still target this high here, and then you enter here and then take your profit here. Simple as that. This is your fair value gap. We can see that we have a space between two candlesticks, and some of them, and another example is this one here. I'll explain this one. We have an aggressive move to the upside, and then we have this. But when we reach this area here, we can see that the market traded below the zone. So that means we don't have a confirmation candle to enter the market. So that means this trade will be invalidated. Okay, we move on, and another one. Let's find another one quickly because I don't want this video to be very long. Another one is this one right here. You can see that we have something like this. Have an aggressive move to the downside, a correction opposite direction of this impulse here. If I move on to the lower time frame like 1 minute, this will be very clear. And then the market, when the market touches this zone close with this bearish candlestick here, that's when you can enter the market like this. You enter the market right here and then target this lows here. I'm not sure if it hit the low. Yes, it did. So that's how simple it is. And some of them, they don't have any imbalance. This one could have failed very easily. See, price traded below the zone, so that means this one is not valid at all. We have another one right here. You can see that the market shoot higher, broke to the upside. You can see that this is a minor bullish trend here. You can see that this candlesticks, they're very fast, but not really that fast. And then we can see another move that is coming to touch the zone, and then enter here when the market closes with a bullish candlestick after touching the zone, and then trade to the upside. This one you should never trade because you can see that we have 1, 2, 3, 4 candlestick and 5, but when the market corrected, it made a correction with 2 candles. So avoid this one here, just avoid it at all cost. This one can be a little bit challenging for some traders to trade inside this correction. Previously, you know that we made this one here, so we have another one here, but we have to understand that this is your impulse, you have a correction like this, and we have a fair value gap around this area. And then when the market closes with a bearish candlestick here, enter, target this lows or even this low. If you didn't get a chance to get out on this area here, just enter here, shoot lower, and then trade this one to the upside like this. Pretty much simple. Let's remove, and you can see this one is a bigger version, but we still have the smaller ones. I can still see, oh, I see one here, I see one here. We can see that we have this one is very good. We have 2 candlesticks only, and then we can see that when the market corrected here, it corrected with so many candlesticks, and we still have some fair value gap here. You enter here with a confirmation candle and let the market move to the upside. And the smaller ones can be a little bit challenging to spot, but it's good for those who want to scalp the market. And then you will understand it when you go and backtest, because this is pretty much simple, because you can see that I'm just moving around in the market like this. Okay, see another one here. We have this aggressive move to the downside. We have 1, 2, 3, 4, 5, 6, 7 candlesticks before the market can come to the upside. But from here we can see that we have like 12 candlesticks going up. And then what you need to do is just do this, wait for a bearish candlestick to close, and then enter the market, trade lower. I know I have been missing a lot of fair value gaps in this setup, but we can see that we have another fair value gap around here. So even if you missed this entry here, you can still enter around here. You can see that we have 1, 2, 3, 4 candlesticks, and then the market started to correct. All you have to do is wait for the market to close with a bearish candlestick after touching the zone, which is this candlestick here, and then trade lower. And you can see the market was very aggressive to the downside. Pretty much simple to understand, but you need to give yourself some time to practice this efficiently, so that when you see them in the market, you don't have to panic. So even if I move on to the 1 minute, let me try the 1 minute. I'm doing this blindfolded. You will see that we will find those ones. Oh, we can clearly see another one here, but this one I don't even like it. I don't like it, even though it played out nicely to the upside, but I don't like it. Let's find, I'm just scrolling around, trying to find at least one here in the 1 minute time frame. Okay, where is it? I need only one. Okay, you can see that we have an aggressive move to the downside. Let's calculate. We have like 16 bars, 10 minutes only, and then we have like 39 minutes of consolidation, and then we have something like this here. The market was trying to touch the zone around here. This is the only pattern that I want to see. There's a huge candlestick to the downside, and then some little bit retracement, and another huge move to the downside. This is a clear, perfect example of this strategy, guys. And then we can see that we have another move to the upside. The market tried to touch the zone, but it did not. And then we see this candlestick close. So you enter the market here when the market close, because we are on the 1 minute time frame. That means you have to be very, very, very fast. That is a quick 1:8, very quick trade. In a matter of 80 minutes, then you are out of the trade. You are done with your day if you are risking too much. Let me try to find another example. Guys, don't forget to join our Discord, because I can share this kind of trade setups every day if I have time to make this analysis. Let's see, let's find another one. Where is it? This one could have failed. Yeah, this one, if I took this one, but no, price traded above the zone before it can shoot lower. As you can see, price traded above the zone, so that means no entry here. Bye. Let's find another one. This one did not touch the zone. Find another one. There's no area. This one that didn't work. I guess, guys, because I didn't find any. Oh, I found it. You can see the market was shooting higher, corrected. In this example, guys, this one is a little bit difficult. Let me try to explain. We have an aggressive move. I will combine this area and this area to enter long here, even though this is the end of a trend. But you have to be very careful when the market is very high in price, because the market can still make this impulsive moves to the downside before it can continue into the downtrend. Some of them, they are very, very, very difficult, like this one here. You can see we have this one, but it didn't play out. Why? But because I like to risk sometimes, I usually take this kind of trades here. Enter here with this candlestick. this one could have failed easily. And you can see, guys, inside this move here, you can still try to enter shorts here. You can see this one is an aggressive move to the downside, but this one is very slow, and the market touches the zone and then shoot lower. So that's how easy it is to understand. I can spot a lot of signals here. There's a lot of signals here. We have a fair value gap around here. Enter along with this confirmation candle, catch this move, take your profit here, and then you're done. You can see that this move is very, very corrective, but what I see here is just waves. We have an impulse, we have a correction like this, and then the market to shoot higher. This is pretty much simple. So if you have any questions, please come to our Discord, communicate with me. I'll help you for free. And also, if you want to join our private mentorship, the link is in the description below. Don't forget to subscribe to the channel, because that will help me to make these free videos. Okay, so see you on the next one. I hope you have enjoyed this video. I know I have messed up in the middle of the video because I started to become very fast, so it's just part of it. I'll just edit this video and post it. So if you want part 2 of this video, please comment below, because there are some information that I have realized in the end of this video that I have missed. So please bear with me. I'll make a part 2. If you comment below, please comment below.